You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. My name is Andy Tanner. This is where investing is made simple. And I have to begin this episode with a shout out to my producers. They always reach out and connect me with the people I want to speak to the most. And there's no one in the world that I would rather speak to today than Richard Duncan. We'll introduce him and I'll tell you a little bit about his background in a minute. But first and foremost, Richard Duncan, it is so good to hear your voice again. And thank you for being on the podcast.
Andy, it's great being back in touch with you. Thank you for having me on.
You know, Richard and I, we met probably 10 or 12 years ago in Singapore, and we went to Australia and Malaysia, and we had a chance to meet speaking together on stage, and I just fell in love with your expertise and your personality. And so we've known each other for, God, can you believe it's been that long? It's been a long time.
Several different countries.
Yes. Richard is joining us from his home in Thailand. And so we're about 11 hours apart. It's just dusk here and just morning there. And so we just appreciate you. I'm going to tell them a little bit about you, Richard, and you can throw in anything else. But Richard began his career as an equities analyst in Hong Kong back in 1986. And so he understands the equity side of things. He served as the global head of investment strategy at ABN AMRO Asset Management in London, and then worked as a financial sector specialist for the World Bank in Washington, D.C., and headed research departments for James Cabell Securities and Solomon Brothers in Bangkok. He also worked as a consultant for the International Monetary Fund in Thailand during the Asia crisis. And of course, you're on CNBC and CNN and BCC and Bloomberg Television. And I highly recommend his 3 books. And you know, Richard, it's funny because I've had people say, don't turn your podcast into an infomercial for people. I says, why not? If I care about what my listeners get and I bring on guests that I'm interested in, why would I not want them to read every word that every guest has written? So you can get these on Amazon.com. And the first one is called The Dollar Crisis. We're going to talk about that. The Corruption of Capitalism was written in 2011. And then The New Depression, The Breakdown of the Paper Money Economy. So 3 books on Amazon that are all 3 in my library. Loved every one of them. You know, The New Depression does such a great job of explaining how debt works, and it's just fabulously done. And then drop by Richard's website, richardduncaneconomics.com, and there's 2 things that we'll do. We'll give you a coupon code. I'll give it to you right now. It's just the month, April. And he will give any listener for the Cash Flow Academy half off of a subscription, very valuable, called Macro Watch. Macro, of course, meaning macroeconomics. And then he also has a monetary policy course. And Richard, I just want to give one more shout out before we start our discussion to you, is that, a lot of my listeners have taken my 4 Pillars of Investing course, and they understand what sovereign fundamentals mean. They understand a little bit about monetary policy and fiscal. This course on monetary policy and this subscription on Macro Watch will keep you up to date and take you to a level beyond which I was able to. So there is no one on planet Earth that I know personally that knows more about this than Richard Duncan. And if the International Monetary Fund calls and asks for his advice, I would imagine people would be interested in that too. So with that, let's talk a little bit about this. Hey, is the U.S. Federal Reserve propping up the whole world right now? I mean, what's your opinion? Let's start there with coronavirus and everything that's going on. This is just an economic meltdown, a standstill more than a meltdown. Give me your thoughts. Let's start there.
If we did not have the Fed, then all of the banks in the United States would be in the process of going bankrupt. Most of the small and medium-sized businesses and corporations would also be in the process of going bankrupt, and the unemployment rate would be moving up somewhere between 30 and 50%. So that's how important the Fed is. Just over the last 3 weeks, the Fed has created $1.5 trillion and pumped it into the financial markets. That's increased the amount of money that they've created in total by 35% in just the last 3 weeks. And that, above everything else, is the reason that people are not going hungry in the United States today.
In the short term, this is quite a life preserver to keep everyone breathing. It's such an irony that physically so many people are going to wind up on life support, but our world economy, this is life support, and I'm not sure that the average person realizes the degree to which the Fed has acted. I look back at 2007 through 2009. That took 2 years to generate all that money and to buy all those securities and print that money. This has happened in 3 weeks, Richard. Have you ever in your entire career seen anything like this before?
No, there has never in history been anything like this before.
It's beyond belief. Now, here's what's interesting is in 2007 and 8, we printed a lot of money, trillions and trillions of dollars, and I don't know if people understand how this works. So there's no one better than you that explain this chain of how this money is created. So let's say that the Fed comes out, or let's say that Congress comes out and say, okay, we're going to do a $2 trillion package. Well, they don't have that money. They're going to have to, sell bonds to get that money. How does the Fed come in? Could you explain the relationship between the fiscal policy of Congress, the actions of the Fed, how that money is created, and what will happen to taxpayers long term? I know that's a lot, but if you could walk us through that chain, because I think a lot of people just hear, okay, the government's going to send out these checks. Well, that money's got to come from somewhere, right?
That's right. So if there were no Fed, where would the government get that $2 trillion from? There would only be a certain amount of money in the world, and they would have to borrow it. So that would push up the cost of interest rates. Interest rates would move from where they are now. Roughly, the 10-year bond yield is below 1%.
Also historic
lows. It would move up to 5, 6, 7, 8%, and entirely crush the economy because of the higher interest rates. So what the Fed does is it creates money and buys these bonds that the government is going to have to sell in order to send out the checks to all the unemployed Americans, as well as to the small and medium-sized businesses, as well as to the corporations like the airlines and Boeing. And all of this will be necessary to keep all the banks from failing as well.
Now, the Fed, officially, they have a dual mandate of employment and price stability. Those are their two big ones that they claim to do. And they've always tried to act like, well, we don't care about the stock market, we just care about the economy, and they're different. But Janet Yellen, I don't know if you saw this, but Janet Yellen, former Fed chair, came out and said, it's about time we gave the Fed power to buy equities. I mean, printing money to buy bonds is just basically, money creation to put debt on the balance sheet of the Fed. But can you imagine them printing money to buy equities to prop up the stock market and put stocks on their balance sheet? To me, that's astounding.
That is astounding, but I agree with Ms. Yellen, Chair Yellen. I think that might be a very good idea. And let me explain why. For decades, the U.S. economy has been driven by credit growth. Credit growth has been growing very rapidly, and that's been giving people and businesses more money to spend as they borrow more, and that's boosted consumption and investment, and that's made the economy grow. In fact, every time credit has grown by less than 2%, adjusted for inflation, every time that's happened since 1950, the U.S. has gone into a recession. Mm-hmm. And it doesn't recover from a recession until there is a new surge of credit expansion. Well, since the crisis of 2008, credit growth has been too weak to drive the economy. It's been just barely at 2%. And so the Fed has had to supplement credit growth by pushing up the stock market and other asset prices like property. And so by driving up the stock market with extremely low interest rates and several rounds of quantitative easing, that's created a wealth effect that has allowed the Americans to keep spending even despite the fact that their borrowing is not increasing as much as it was in the past. So we have two things driving the economy. One's credit growth, and one is asset price inflation, or in other words, the stock market going higher.
Right.
Well, so now we're facing a terrible crisis where both of these pillars are crumbling because people are going to begin defaulting on their debt in record amounts. So credit's not going to grow, it's going to contract. And on top of that, the stock market has crashed by more than 20%, at one point more than 30% before the Fed stepped in. So if the stock market keeps crashing, so this is a double blow, which is more than sufficient to drive the economy into a depression if the government doesn't respond with enough fiscal and monetary stimulus combined. So getting to your point, your question, if the stock market keeps crashing, then the big banks and the big investment houses are all going to start going bankrupt. And if the big banks start going bankrupt, the government will have to bail them out, but it's going to cost trillions and trillions of dollars to bail out all these enormous banks once again. So rather than allowing a collapse of the stock market to bankrupt the entire financial system at the cost of trillions of dollars to American taxpayers, it makes more sense for the Fed to simply start make an announcement, all right, we're going to start buying stocks. And as soon as they make that announcement, because there's no limit as to how much money the Fed can create. So the Fed said it was going to start buying stocks, then every investment manager in the world would also immediately jump into the market and start buying stocks.
100%.
And the stock prices would go higher. And if any professional investor didn't buy stocks, he or she would probably lose their jobs because they would so radically underperform when the stock market went back up 20, 30, 40%. So it wouldn't cost the Fed very much money to prop up the stock market just by making the announcement that it intended to begin buying stocks. And that would save the government ultimately trillions of dollars by preventing the collapse of the entire financial system, the banking system. So, yeah, I'm on board with that.
What's fascinating about this idea is you look at a person like Warren Buffett, and you are an equity analyst, so you understand equities, is that if you look at an equity as a business and you say what profits do they make, what growth do they make, earnings and growth, those are the two basic things in equity analysis, is earnings and growth. But all of a sudden, you've had this gradual detachment from, price, like a PE ratio. What do I buy for this little jack in the box that makes $1 for me, right? Whatever that might be, an airline or a railroad or a pharmaceutical company. So you had this fundamental thing of saying, look, we're buying something that earns money. All of a sudden you start 401ks and people are buying for the sake of buying. And now, it seems to me there's a divergence in the stock market to say, if the Fed starts buying and everyone else starts buying, we're no longer buying stocks for the sake of getting a business that pays a dividend. We're buying stocks for capital gain reasons based on the supply and demand of stocks themselves. Do you see a divergence away from fundamentals to where people look at more technically of stock price rather than the underlying fundamentals? Could you comment on that?
Yes, I think that is a trend that has been occurring for some time now, particularly as the Fed has actively tried to make the stock prices go higher, going back more than a couple of decades. But in this crisis we're in at the moment, we really do need to think of this as if we are at war. Mm-hmm. This is a wartime-like crisis that requires a wartime-like response. For instance, in World War II, total U.S. government debt expanded by 5 times in 4 years. And the amount of government bonds that the Fed owned increased by 11 times. And during the war, of course, the government took over nearly complete control over the economy. They pegged interest rates.
Yep.
They took over manufacturing. They controlled prices and wages. And of course, they distributed the goods around the country. They imposed rationing where necessary. And they drafted people and sent them off to die. So wartime. So we are in a wartime environment. And if that necessitates the Fed creating trillions of dollars and the U.S. government running trillion-dollar budget deficits, which of course it will, then so be it. This is what we have to do to keep our economy now from collapsing. So rather than thinking in terms of sort of 19th century textbooks on capitalism and market forces and laissez-faire, we have to realize that's not the world we're in. We left that world a long time ago. The world we're in has been a world where the government has been directing the economy through a combination of government spending, fiscal policy, and monetary stimulus, the Fed. And now both of those forces, fiscal stimulus and monetary policy, are going into overdrive out of necessity in order to keep our economy from completely collapsing.
You make a wonderful point pointing back to wartime of World War II, because if my memory serves, our debt to GDP of the United States, at least in my home country, that's probably the biggest it's ever been. I mean, I think now we're over 100 debt to GDP, 100%, but I'm sure that during World War II it was far greater than that. Am I right in that recollection?
Well, so you're right. It is over 100% now. It's about 107%. At the end of World War II, 1946, it peaked at 114%.
Okay.
And then it came down. But so I think on March 15th, I published a Macro Watch video called Recession or Depression. And that was before people started talking about a depression. That was before the Fed launched its QE and infinity, as the press is calling it now.
Yeah.
And I made this point. Look, whether or not the U.S. only going to experience a recession or whether it collapses into a depression depends entirely on the speed and the size of the government's policy response in terms of fiscal stimulus and monetary stimulus. And I said, but fortunately, the U.S. is a very wealthy country, and we can afford to spend whatever it takes. The government can afford to spend whatever it takes to keep the economy from collapsing. So, for example, our economy, the size of the economy, the GDP, is approximately $22 trillion. Now, just as an extreme example, I think everyone is aware that the Congress has already passed a $2 trillion bill to provide relief during this crisis. But take an extreme example where the government actually had to spend $22 trillion, an amount exactly the size of the U.S. economy. Well, that would double the size of the U.S. debt, the U.S. government debt.
Right.
Take from 107% of GDP up to 214% of GDP. Now, that's an extreme example.
I'm sorry to interrupt you, but Japan's at 250 right now, right? I mean, it's been done.
That's my point. That was exactly my next sentence. Japan already has 250% government debt to GDP. And do they have hyperinflation? No. Do they have double-digit interest rates? No. It costs the Bank of Japan, it costs the Japanese government zero to borrow money.
And that's not new. They've been at 250. They've been at 250 GDP debt to GDP for years.
That's right. In 1990, when their crisis started, their government debt was 60% of GDP. Since then, it moved up to 250, and as you said, it hit that level quite a few years ago, and it's flattened out. But it will soon begin rising again because as they respond to the crisis there. So the point is the U.S. government has the firepower. They can spend as much as necessary. We have the resources to win this war. And they've made it, since that video on March 15th, they have definitely made big steps in the right direction, both with the Fed and with the Congress. I was very pleased and impressed that they moved so quickly with this $2 trillion spending bill to keep the economy from collapsing. But it's going to take more than that. It's going to take a lot more than that, and everyone needs to recognize that. But also, everyone needs to understand that we can afford that, and that is simply the price we're going to have to pay. If we have to end up spending $5 trillion, $10 trillion, then so be it.
There's going to be, I agree with you that there's going to be a need for more stimulus. They're going to suck this out right now, these SBA loans, the PPP program. That money's going to be vaporized in a matter of weeks. And the real estate investors that have lost their, we've got guarantees they can't evict. Well, now you've got to figure out how the banks don't foreclose, and so that real estate investors run pretty hot. So here's the thing that people worry about, and it's the $64,000 question. When we started printing this money, in copious amounts back in the subprime meltdown, we'd killed interest rates, dropped into zero, Operation Twist, tweaked everything we could tweak pretty much. And we had rounds of 50 billion a month. Then we went to unlimited for a while, calmed it down, tried to go to patience, and the market started to fall, so they dropped down interest rates again. But the idea of printing money out of nothing scares a lot of people. It scares me. I'm going to read you a statement by Ben Bernanke, and then we're going to contrast that with this. And this is what people really would like to learn from you. It's what I really want to learn from you. I said at the top of the show, if there was one person I'd want to speak to right now, it'd be my friend Richard Duncan. And just for those of you, remember that we're speaking with Richard Duncan. Go to richardduncaneconomics.com. Check out his Macro Watch subscription. He's going to give he knows our listeners are savvy to this. He's going to give you great discounts and also a monetary policy course. Let's go to Ben Bernanke. This is what he said. He said, what has this got to do with monetary policy? Like gold, U.S. dollars have value only to the extent that they are strictly limited in supply. But the U.S. government has a technology called a printing press, or today it's electronic equivalent, that allows it to produce as many U.S. dollars as it wishes at essentially no cost. By increasing the number of U.S. dollars in circulation, or even credibly threatening to do so, the U.S. government can reduce the value of a dollar in terms of goods or services, which is equivalent to raising prices of the dollars, those goods or services. But here's the line. It says, like gold, they have value only to the extent that they are strictly limited. And that phrase, strictly limited, is exactly opposite and opposing to the headlines I'm seeing now, where it will be an unlimited supply of money. So why is it that we can look at this incredible increase in the money supply in one graph, and then in another graph we have a consumer price index that's flat? To me, that's astounding. An almost parabolic graph of money supply creation, and yet a flat consumer price index over the last 10 years. How does that work? How does that happen?
So that Bernanke speech was probably the most important speech ever made by a central banker. It was made in November 2002.
November 21st. You're good, Richard, man. November 21st, 2002. You know your stuff.
The speech was called Deflation, making sure it doesn't happen here. And he was, at that time, this was, of course, 2002, long before 2008.
Right, this is Greenspan days. Yeah.
But this, when Bernanke signaled that they would use quantitative easing in terms of if there were a crisis. And this is, at this point, he wasn't even Fed chairman. He was just a governor. But this is probably the speech that got him promoted. And luckily it did, because Bernanke, with quantitative easing, kept us from collapsing into a Great Depression in 2008.
Yeah.
Now, to answer your question, how do you create all this money? So the Fed, at the end of 2007, during the Fed's entire history, up until then, it had created about $900 billion. Well, between the end of 2007 and the end of 2014, through 3 rounds of quantitative easing, it had created another $3.5 trillion. I mean, just in the second half of 2008, the Fed created as much money as it had in the previous 90 years.
It's a 400% increase in our money supply, right? Somewhere in there.
Right. Actually, I was doing the numbers the other day. It's a 5 times increase.
500%. Jeez.
So why didn't that cause inflation? Well, normally if the Fed creates a lot of money, or any central bank creates a lot of money, back in the olden days, it certainly did tend to create inflation. That's because if the government spent too much money, or if the Fed created too much money, and that overstimulated the economy. And up until 1971 or so, all of the economies were very closed. There were not big trade deficits between countries, but because we were on a gold standard. And if one country had a big trade deficit with another country, it had to pay for that deficit by sending its gold to the other country.
Yeah.
And it would run out of gold. And since gold was money, its economy would go into severe crisis. So trade had to balance. But after the Bretton Woods system broke down in 1971, money was no longer backed by gold. And the U.S. quickly found out that it could buy things from other countries and it didn't have to pay with gold anymore. So it didn't really realize that until the early 1980s. But by the mid-1980s, the U.S. trade deficit had blown out beyond anyone's imagination. It reached 3.5% of U.S. GDP in 85. And then China entered the global economy in 1990 or so. And by 2006, the U.S. trade deficit that 1 year alone was $800 billion, 600% of GDP, something like $1 million every 2 minutes. And so we were buying things from other countries with extremely low-cost labor. Yeah. And so, whereas in the past, too much government spending and too much money printing overheated the domestic economy and caused wages to go up because everyone was fully employed, and caused car prices and steel prices to go up because the factories were working at full capacity. Well, once we moved to globalization and started running these extraordinarily large trade deficits, we no longer had domestic U.S. bottlenecks, because now, afterwards, at that point, we had a global economy. And today in the global economy, there are 2 billion people who live on less than $3 a day, who would be delighted to work for $5 a day. Mm-hmm. So this is extraordinarily deflationary. We no longer have domestic bottlenecks. We have a global economy with massive excess capacity of everything, and a workforce numbering in the hundreds of millions of people who work for less than $10 a day. So these extremely deflationary pressures of globalization offset all of the inflationary pressures that would normally arisen from all of the paper money creation by the Fed and the other central banks around the world who were doing something very similar. So that's why we didn't get inflation this time. But looking ahead now, that raises, as we look forward now and toward the post-virus world,
yes,
where is globalization going to be when all of this ends?
Yes.
And we already had a trade war going on between the U.S. and China before this started, and that was supported by both Republicans and Democrats. There had been a serious change of heart about our relations with China and whether or not we were benefiting from it. And the conclusion basically was that we are not. And so that was before the virus. Now, suddenly everyone has been made to realize that because of our supply chains extend all around the world, we're no longer capable of making surgical masks in the United States, or ventilators, or medicine. So there's going to be a serious rethink about how much manufacturing is allowed to occur overseas and what has to be done in the United States. So will globalization completely collapse? Of course, that's a possibility, but it probably won't completely collapse. But if it does, then we would immediately move back into the 1960s and 1970s era, when too much government money creation and too large budget deficits led to very high rates of inflation. And we would be back to an era of double-digit inflation and double-digit interest rates, which would be catastrophic for the U.S. economy and for all of the asset classes. So what will actually probably happen is somewhere in between. We won't go back to the world we lived in 5 years ago, but globalization won't entirely collapse either. Where things end up along that spectrum between those 2 points will determine whether or not we have inflation or not inflation.
You know, it's an interesting thing, the way debt can deal with asset prices. When we go back to 2007 and 8, even 6, you have very loose requirements to get mortgages. If people can buy things on debt, that asset price goes up. If you took away mortgages, obviously real estate would plummet because people couldn't buy it. My opinion is if you took away student loans, tuition would plummet because people wouldn't buy it. We have so many people in student loans. So when you give people the power to borrow money, they'll borrow what they can and they'll spend it, and that drives things up. Like you say, credit is everything. But at some point, when I look at us fiscally, we've got a $22 trillion GDP. We got 23 trillion in bonds we've borrowed that money from, but that we probably have, and your number might be better than mine, but I'd say we probably got 125 trillion of promised money, not borrowed money, but promised money for medical dependents and pensioners of the United States government. So at what point, it's a fascinating thing. Japan is 250 debt to GDP. At what point does that overheat? At what point do we say, gee, we have these baby boomers that are going to qualify for Medicare and Medicaid even without a virus. We owe them $122 trillion. That's a lot bigger than 100% debt to GDP if you count the money that's promised. So what do you see in terms of paper money? What's your feeling for cash in the long term in the future of the U.S. dollar, considering coronavirus and this new stimulus, but also the old existing fiscal promises that every report I've read says is unsustainable?
Well, so, it's very important to understand that for every period of time, circumstances are different.
Yeah.
And therefore, the economic theories that are appropriate to different periods of time differ as time and circumstances change. What most people, most economists and individuals in the world don't understand is how radically our economic system changed once no longer backed money with gold. Up until the late 60s, early 70s, for every dollar the Fed issued, it had to maintain gold. It couldn't issue any dollars without maintaining gold backing. So that was, you could say that was something more closely resembling what people think of as capitalism.
Yeah.
But since that time, our economic system has been entirely transformed by credit expansion. Credit growth has been so extraordinary. For example, total debt in the country is equal to total credit, since one person's debt is one person's asset.
Yeah.
So total debt, you can define it as all the government debt, all the household sector debt, all the corporate debt, all the financial sector debt, all the debt, period, all the debt in the country. It first went through $1 trillion in 1964. Well, by 2007, 43 years later, it had expanded by more than 50 times to 53 trillion, and is now 73 trillion. So this credit growth has been driving, it has created our world. It has completely transformed our world. Our world now is entirely dependent on credit growth.
Yeah.
And if credit doesn't grow, the economy goes into recession. And if credit contracts, the economy goes into a depression. And if it contracts very much, it goes into an extreme depression that could have devastating social, geopolitical consequences across the board. So, given that, we have to find a way to. We have a new economic. I call this system not capitalism, but creditism.
Yeah.
Because capitalism was driven by saving and investment, and profits generating more capital, hence capitalism, and more investment. But that's not the way our system works anymore. Our system is driven by credit creation and consumption, more credit creation and more consumption. Now, the problem is in 2008, we reached the point where the private sector had so much debt that it couldn't take on any more credit. In fact, it couldn't even repay the interest on the debt it had already borrowed.
Right.
And the private sector started to collapse. The government sector then had to jump in, and the government's debt has tripled since 2008, tripled.
Yeah.
And so that increase in government debt is the reason we haven't collapsed into a new depression. All right, so now, returning to your question at long last, what about the future? How do we get out of this? Well, we need to, rather than just taking the approach, as so many people do, sadly, that we're just doomed and we might as well give up and go crawl into a cave and die. No, that's not right. We are in a new economic environment. We have to find new policies that are going to get us out of this situation, just like all of our previous generations did when they faced crises. So rather than just preaching nonstop doom and gloom, all of these people, many of whom are extremely intelligent, should spend a whole lot more time working on solutions. Yeah. And here's my solution. This is the best I can come up with. Look, since we need to have credit growth to keep the economy from collapsing, then how about this? What I would like to see is and this was, of course, I worked all this out long before the coronavirus struck, but I've been proposing that over the next 10 years, for instance, I believe the US government should invest $10 trillion in the industries of the future. Things such as artificial intelligence, genetic engineering, biotech, nanotech, robotics, neurosciences, and you know the list, all the industries of the future. And if we do this, $1 trillion is still an enormous amount of money. If we did this, we could cure all the diseases.
Well,
we could expand life expectancy by decades or more.
To your point of wartime, there's a war between the U.S. and China for AI, in my opinion. Like, China is serious about their AI, and where they have an advantage is that they have, 1 billion people to practice on, right? They have such a large population to practice AI with that you almost would want to take a wartime status in that idea and say, hey, let's invest heavily because whoever wins the AI war will have a huge leg up in the future. True?
That's true. But and I'd like to come back to that, but just finishing up on the previous point that you raised, so how do we save Social Security and Medicare? You were talking about $100 trillion of commitments. Well, we can wait and let all these people get old and sick, or we can invest and we can cure all the diseases and let them live 20 years longer and work 20 years longer. And then that $100 trillion cost that you just described disappears. Plus, we cure cancer and heart disease and diabetes and all the other diseases, and everyone is much happier and healthier far into the future. That's how we solve this crisis, because we now have the ability for the government to borrow and invest trillions of dollars, as we've seen over the last 12 years, and for the Fed to create money and finance most of that with newly created money without causing inflation. So this is a new economic theory that's appropriate for our time, rather than relying on the teachers who were brilliant back in the day, people like Ludwig von Mises, who taught that credit economics. Austrian economics, who teach us basically we have sinned and therefore we must go to hell now. I don't accept that. We're in a different economic environment and we have to find our way out of it with new economic theories and new approaches. We have a once in history opportunity now for our government to invest on a multi-trillion dollar scale in the industries of the future, which would induce a new technological revolution. And as you've now coming to your important second point, exactly, China last year, China invested more in research and development than the United States did. Last year, China rolled out 5G in 50 Chinese cities, and it will soon, be all in every Chinese city. Yeah. So China won the 5G race. If China wins the AI race in the way that they have won the 5G race, then that would be the 21st century equivalent of China having a nuclear monopoly. We can't allow that to happen. The United States government, sadly, public opinion swings back and forth, and government policy swings back and forth. Sometimes it swings too far to the left, and sometimes it swings too far to the right. But over the last 3 decades or 4 decades, we've swung from where we were, say, in the 1960s, when Russia launched Sputnik in 1957 or 58. We responded with such increases in U.S. government investment in sciences that we won the space race. And we sent a man to the moon. And along the way, as a result of all that government investment and spending, we developed fantastic intercontinental ballistic missiles that the Soviet Union couldn't keep up with, and they eventually went bankrupt trying. because of government investment in the military. But since then, we have swung so far back in the other direction that government investment has shriveled up to extremely low levels now. And that accounts for much of the reason the U.S. economy has performed so weakly in recent decades and why we're losing our relative economic position to China.
Yes.
If current trends continue, by the end of this decade, China will be investing 40% more in research and development than the United States does every year, and then it will just accelerate from there. So if China gets AI before we do, if they reach artificial general intelligence where computers can do everything humans can do, after that it goes exponential. Whoever gets there first will have the rest of the world at its mercy. We can't allow that to be China. Therefore, the government needs to invest very much more, and fortunately we can afford to do that. That's what we need to do.
The other thing that I'd throw out here, we mentioned MacroWatch subscription. We're going to give the website out again here in a minute, and Richard's monetary policy course. You and I are both educators. We both have courses we offer. And the reason that's significant and important is when you have China who has leadership that gets to do whatever they want, you'll have a political swinging like you talked about from left to right, usually by people who are uneducated in the United States. In other words, without education, without understanding, if a person's listening to you and I and they cannot follow this conversation, they don't know it, how are they going to get the political will mustered to know what needs to happen and whether to swing right or swing left or be smart and just do what's smart? And so I just have to say that the education component, these things are not taught well in high schools or colleges, in my opinion. They're not taught, which is why it's so important to connect with people like Richard Duncan to learn these types of things so you can help shape not just your personal financial future, but your collective. Perhaps our greatest asset right now isn't gold or silver, it's probably each other and helping each other as a people. So this is fantastic, fantastic stuff, Richard. Let me ask you this. All the asset classes seem to drop at the same time for a moment, and this is interesting because gold is usually inversely correlated to the dollar, and we saw, and it's also often inversely correlated to equities, because when people are scared, they leave equities and they fly to gold. It seems like there was a flight to cash here. It seems like people were dumping everything for coronavirus, trying to get cash, which is interesting because supply and demand, that makes the dollar more valuable even though you're printing it. Is that correct?
Yes. I think it's useful to think of all of the asset prices in this way. All of the assets, the value of stocks, bonds, property, gold, commodities, all the asset prices, in other words, the wealth, all the wealth is floating on an ocean of credit.
Yeah.
If credit expands, all the asset prices go up. If credit contracts, as it would in a depression where all the banks fail, then all the asset prices collapse. Of course, some collapse more than others, but they all collapse.
Fascinating stuff. It's your ability. It's a great lesson from 2007 and 8. If you have the ability to buy, you will. That creates demand. It's the ability to buy that creates demand, and credit gives people the ability to buy. Of course, one point I'd like you to touch on here is, 07, 08, those are demand side deficits or demand side problems. It almost seems like coronavirus is more of a supply side issue. Do you agree?
Well, I think it's a double problem. We have supply side issues, but we also have demand side issues. So on the demand side, first, since everyone has to stay home and since so many people have lost their jobs, people don't have the money to buy things.
No demand.
The demand is collapsing. So this is very deflationary. It's a deflationary demand shock, unlike anything we've ever seen before. And that's why oil prices have crashed to below $20 at one point, a barrel. But on the other hand, this is in a sense also a supply shock in part because American companies couldn't necessarily obtain the products from China to sell in the United States, or is a supply shock, and that we
close.
desperately need more ventilators and we need more surgical masks. And so the prices are going up because there's a shortage of that supply. So it's a combination of both. And if this crisis persists for many months, then we'll see increasing shortages as production shuts down across many industries. And shortages then would lead to a supply shock in which the price of many goods may start to rise just because there's not enough supply.
Fascinating stuff. We're speaking with Richard Duncan, the smartest economist that I personally know, consultant to the IMF. Fantastic. His website is richardduncaneconomics.com. And I'm going to give you guys a code to put in there. The code is April. It's just the month April. And when you go there, there's a little button you can say subscribe to Macro Watch. It's a steal for what you get. There's videos, there's a library, there's an archive where you can follow what Richard does and stay up to date on what he's thinking. So there's a little gold button that says sign up now. You can enter that code April, and he'll give you half off on that subscription. You've been so gracious as always with the time. It's so fun to talk to you again. It's really good to hear your voice, and amazing we can do this Skyping. It's like you're right next to me, so it's really fun. Do you have any counsel? If someone's listening and they're trying to follow this, a lot of our listeners are educated, so they'll get it. Some are like saying, wow, these guys are talking in circles around me. What is your counsel to people over the next 3 months and over the next 5 years? What would you say?
Well, so of course, the appropriate advice in terms of investments, at least, varies from one person to another.
Yeah.
It depends on how much money each individual has to invest and how high that person's risk tolerance is. So it is very difficult to make sweeping investment recommendations.
It's funny because you say that, because I just asked you what people always ask me, and you just gave me the answer I give to other people.
Well, that's so true. I mean, what someone with $10,000 should do is very different from what someone with $1 billion should do, of course.
And I'll throw this in. Someone with a financial education is going to do things differently than someone who has no education. And that's really what it comes down to, is how much you learn and how disciplined you are when all this stuff comes down. Richard, thanks you so much for being on the podcast. It's so good. We need to talk more often. It is so fun to be with you.
Andy, I've really enjoyed this conversation. If I could, let me just mention what Macro Watch is.
Yeah, please do. Tell them a little bit about what they receive and what they get.
Macro Watch started 6.5 years ago. It's a one-man show. Every couple of weeks, I upload a new video. It's essentially me making a PowerPoint presentation with lots of charts describing something important that's happening in the global economy and how that's likely to affect the price of stocks and bonds and commodities and currencies and economies. And so if people subscribe to Macro Watch, they'll receive roughly 25 new videos over the next year, but they'll also have immediate access to the Macro Watch archives. And in the archives, there are more than 50 hours of Macro Watch videos now, including a number of different courses. There's one course called How the Economy Really Works, another course called Capitalism in Crisis, one on China's economic crisis, and one I think that's particularly important now is a course on understanding monetary policy, which is the most important factor driving the global economy. So I hope your listeners will go there and check it out, because it pretty much does explain everything significant in macroeconomics and the major events driving the global economy and the U.S. economy and asset prices today. And at the very least, they can subscribe to sign up for my free blog if they visit richardduncaneconomics.com.
Absolutely fabulous. I couldn't agree with you more in that it's not just the Fed. You have the Bank of Japan, you have the European Central Bank. I mean, central banking drives the equities market, and it's a very difficult thing to get a head around, because if you're a Warren Buffett guy, you're thinking about, okay, we make this widget, we sell it, we get paid, we have earnings and growth, and that's why people should buy business. Not anymore. People buy assets for the sake of buying assets, and as credit expands, they use it to buy assets. In fact, gold is an interesting thing, because if you have more credit, do you buy more gold? I mean, gold is usually up when the dollar's down, but if you print money, will people use it to buy gold and drive that asset higher? So it's fascinating stuff to try to wrap my head around. I'm not nearly as smart as my friend Richard, but I can't thank you enough for sharing what you know and making your products and your education available to our listeners, Richard. Thank you, thank you, thank you. Stay safe. Be healthy, and I know you're working on another book, so when that gets closer, will you come back?
I definitely will. It's been a real pleasure talking with you again. Let's stay in touch.
For sure. Thanks so much, Richard. Fantastic. You've been listening to the Cashflow Academy podcast. This is Andy Tanner, where investing is hopefully made simple. We'll see you next time.
You've been listening to the Cashflow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.